Hello, everyone. Today we're going to be going over how to put a vehicle on your books. So you go out, you buy a truck, you bought a car, you need to put that on QuickBooks, make sure it's recorded correctly, and also the payments, make sure that those payments are getting recorded properly in QuickBooks. So I'm going to walk you through how to do that. When you buy a vehicle, typically people are going to get two documents, and I have those here. These are fake chat GPT documents because I'm not going to use my client's data and put that on the internet. But the first one would be just some form of purchase agreement, some sort of sales receipt. And really what we're looking for on this is the total cash price. And this is kind of realistic. You know, you pay $45,000, you're going to have your documentation, title, fees, sales tax. That's all going to get wrapped up into the final purchase amount for the vehicle. And then you're also going to have some sort of sales contract, assuming that you finance it. And really what we're looking for on here is the total amount paid. So this 48,000, down payment 5,000, and amount financed. That's going to give us the information we need to get this on the books. And then to make the payments, we're going to need this information down here. You're going to need your interest rate, term, 60 months, and the payment and the date of starting the payments. So let's just start walking through that real quick. So I'm not trying to make this an accounting lecture. I'm just trying to show people how to do this. So without getting too much into all the debits and credits, I'm going to do a quick walkthrough. So we're going to go to Create, Journal Entry. And you can kind of name this however you want. But the type of vehicle that was purchased is usually a good way to name it. So like 2024 Ford Bronco. That was the vehicle that ChatGPT chose. So we're going to go to account. We're going to type in 2024 Ford Bronco. We're just going to hit add there. You'll see this will show up to add a new account. We'll just make that the name. And we will choose fixed assets and scroll down to vehicles. I like to make this a sub account of vehicles, but that's not listed here yet. So I'll show you how to do that if you're interested. So for now, we'll just hit save. So we have that fixed asset on the books. And then what we're going to do is we're going to put a debit for the whole amount. So in this case, the whole amount, $48,657. So 48,657.50. And then we're going to need our finance agreement to make the other part of the entry. So in this case, $5,000 was put down. So we can make a entry here for our bank account that was used. So our fake checking account, $5,000 came out of it. And then we have a loan for the other 43,000. So I would name it something like this. NP for notes payable dash 2024 Ford Bronco. If you wanted to put the name of the financial institution, so let's just say your loan was through Wells Fargo, that might make it a little easier when the transaction comes through, you know which loan it's going to. So if this said notes payable Wells Fargo, that'd be fine too. So we're going to add this account. This is going to be a long-term liability, notes payable, save. And that's the difference. So 43,657. 43,657. So that'll do it for that. I'm just going to hit save and close. So now if we go to reports, standard reports, balance sheet, we'll see that on the assets section, we have a Ford Bronco for 48,000, and then we have our loan for the Ford Bronco for 43,000. The $5,000, even though it went through as a journal entry instead of a check or an expense, when you go to do your bank rec for the next month, it'll still show up in that bank rec screen, and you can still reconcile it like you would any other transaction. And then what you were going to want to do is figure out how to make these payments every month, because the whole amount doesn't just go to this. There's going to be interest expense, and you do want to make sure that you're recording that correctly. I've seen people write that off as auto expense, which the whole thing's not an expense, just the interest portion. I've seen some people book it against the asset account, so every time they make a payment, the value on the balance sheet's just going up. So we don't want to do that. The cleanest way to do this is just to get your statement from the bank every month, and the bank statement, not the bank statement, but the loan statement will show you, how much of your payment was principal and how much of it was interest. But a lot of the time people don't want to get those. So the easiest thing to do is to create an Excel spreadsheet. So if you have Excel, you should have the option to find loan amortization schedule, or you can type it in. So we want a generic one though. So we'll do loan amortization schedule, create, and then we're going to put the information off our finance agreement here. So the amount financed, $43,657. So we're going to put that here. Interest rate is going to be 6.49%. 6.49. Loan period in years. Most finance agreements are going to show you in months, right? So 60 months is pretty standard. That's, divide by 12, that's 5 years. Payments start on February 15th, 2026 in this case. And we'll get rid of this extra payment, assuming you're not making one. And then the scheduled payment is going to be $854, which if you look at this agreement, that's going to be $854. So we have this saved, and we can use this to break out how much of the $854 is principal and how much of it is interest. So when we're doing our categorization for next month, we're going through QuickBooks, we're entering all of our transactions. We're going to see a charge for that amount. Let me get into the bank register to show you. View register. They used sample auto mall as the fake one in this case. So let's just say that, the bank transaction hits on 2/16/2026. And on our bank statement, it so shows up as sample auto mall. So that's going to be our vendor. The payment is for $854. And this is where it gets a little bit different. We have to break out the account. We can't have it just be one account. So we'll assign it to notes payable for Bronco. It doesn't look like it's giving me the option to split here. It might be because I'm using like a cheaper version of QuickBooks, but there is a way to fix this. So for now, we'll just book it against the liability. And then what we can do is we can go to our balance sheet. So reports, standard reports, balance sheet. This transaction took place on the 15th of next month. So if we click on this, we should be able to see that payment. So yeah, here's our initial recording of the loan from when we purchased it. Here's that payment. So if we click on that payment, we should be able to split it at this point. And the reason we're splitting it is because not the whole payment is decreasing the loan. If we just leave it at $854, what's going to happen is it's basically saying that this whole $854 amount went towards decreasing the loan. That's not the case. Only 617 went towards decreasing the loan, and 236 went towards interest. So we're going to take those numbers and we're going to put them in QuickBooks. So 617.89. And then for this line, we're going to do interest expense, 236.11, and we have 854. So sometimes what will happen is Excel will not round correctly, and this whole payment might end up being 850.01 or 853.99. It might be off a penny in either direction. If that happens, it's more important that the payment stays the same, because if you change the payment, your bank reconciliation is going to be off from the prior month on whatever that amount is. So I would just book the penny, usually against interest, if that does happen. It's pretty common. But yeah, so what we're doing is we're taking the $850 payment. We're saying, hey, 617 of it went towards paying off the loan, and 236 of it went towards paying for interest. So we're going to do save and close. That'll do it for this video. So if you ever buy a vehicle or buy a car, you can use this as a reference. This will show you how to get the vehicle set up on the books initially, and then how to make the payments every month. Hope this helps.